In the midst of this latest Bitcoin correction, the entire conversation has collapsed into noise. Four-year cycles, chart patterns, manipulation theories, institutional flows, who's selling, who's waiting to buy lower, and look, Bitcoin is a market. These conversations matter. But when this is all we talk about, it's usually a sign we've lost sight of why Bitcoin exists in the first place. Because Bitcoin wasn't created to outperform a chart pattern. It wasn't designed to win a cycle trade. And it definitely wasn't meant to be just another way to grow your fiat net worth. Bitcoin was created in response to something far deeper, something civilizational. So today we're going to rewind the story, back before ETFs, before institutions, before crypto, back to the moment money itself broke, and what that break did to humanity. Because once you look more deeply at what broken money did to civilization, you'll never look at Bitcoin the same way again. Welcome to No Second Best, the show where conviction meets reality, and reality points straight to Bitcoin. I'm your host, Hurley. Now let's get into it. One of the voices that shaped my understanding of Bitcoin more than almost anyone else is Saifedean Ammous. His first book, The Bitcoin Standard, was a genuine light bulb moment for me, especially the chapters on World War I, fiat money, and how modern wars became possible once governments learned how to print instead of ask permission. Since then, Saifedean has gone even deeper. The Fiat Standard, Principles of Economics, and now his latest book, The Gold Standard, which imagines an alternative history where money never broke in the first place. Recently, Saifedean sat down with Danny Knowles of What Bitcoin Did, one of the best Bitcoin podcasts in the space. And it was one of those interviews that pulls you out of the price charts and back to first principles. Not Bitcoin as a trade, not Bitcoin as a cycle, but Bitcoin as a response to a civilizational failure. And it starts with a misunderstanding almost everyone still has. Most people think fiat money began in 1971 when Nixon closed the gold window. That's when the dollar officially severed its last link to gold. But that's not actually where the story began. The real break happened more than half a century earlier, in 1914.
And most people think of 1971, which, is the point at which the last link was severed with the gold standard. So you could make a case for it being 1971, because up until 1971, the US dollar was to some extent redeemable in gold. Central banks could redeem their dollars for gold, but normal people could not. But that process really started in 1914 with World War I. And I discussed this in detail in the Fiat Standard, and then I discuss it again in detail in the Gold Standard. I think it's an enormously important story that very few people know about, because it was only revealed in 2017, which is really incredible. And the war started in 1914. And the way that Britain got into the war had always been shrouded in mystery. And there was always debate in Britain about why we got into the war and should we have gotten into the war. But the people that had argued we shouldn't have gotten into the war, their position, I would say, has just continued to get stronger and stronger over time, because over time it just became clear that there was no reason for Britain to get into the war. And then in 2017, the Financial Times, actually it was a bunch of people at the Bank of England who dug in the basement and found this old report. And then they read the report and then they published it in 2017, 103 years after the events happened in 1914. And in that report, it was revealed that the reason that Britain got into the war was the Treasury sold a bond auction. They made a bond auction to fund going into the war, and they offered a good interest rate. Interest rates at that time were around 2.5%, but this was, I think, around 4%. And they thought they would sell it. Britain was the richest country in the world, and people liked their country, and countries at war, so they're clearly going to be selling the bonds. They didn't. They sold less than a third of the bonds. People didn't buy them. I think this is to the eternal credit of the British people that they didn't buy that. It's really a point of pride.
Was that the first case of printing money to fill that gap?
I'm sure it has happened before in the past, but I think this was really the birth of the Fiat Standard, because it institutionalized and standardized the way that this operated, wherein the central bank lends to the government and the government enforces the bank's monopoly on money, which makes sure that the banks don't get rugged and the government doesn't get rugged. So what they did was they got 2/3 of the bonds to be purchased by two guys who worked at the Bank of England, who got a credit line from the Bank of England, and they just went and bought 2/3 of the bond auction for the war, which is incredible. There was just two guys who funded Britain's entry into World War I, which is what destroyed human civilization, arguably.
As Saifedean lays out, Britain didn't vote for fiat money. The public didn't choose inflation. They were dragged into it through war financing. The government tried to fund World War I honestly, and how they always have throughout history, through war bonds. But the public said no. So the central bank stepped in, credit was created, the war was financed anyway. And in that moment, a dangerous precedent was set. If the public won't fund the war, the money will be created without them. That mechanism, central banks monetizing government debt, never went away, and it became the template. World War I is usually taught as the catastrophe that set the stage for World War II, through debt, reparations, and economic collapse in Germany. That part of the story is widely understood. What's far less understood is why that chain reaction never actually ended. Safedean's argument isn't just that World War II followed World War I, it's that both wars were symptoms of the same monetary break. Once governments learned that they could finance conflict through inflation instead of consent, war stopped being an emergency and became a policy tool. And that monetary chain reaction didn't end in 1918 or even in 1945. It's been compounding ever since.
You look at the economic problems of the 1920s and 30s, they were all a consequence of the inflation of World War I. It's not taught that way because we live in a world where everything is inflation propaganda. But it was all the ramifications of the inflation of World War I. That's what led to the problems of the 1920s in the US and Europe. And that's what led to more inflation to try to fix those problems, which eventually led to the Great Depression, which led to World War II. And World War II, of course, is a huge part of this. But even just beyond World War II, we went into this world where governments are always able to finance themselves because they just have this fiat system where everybody has to use the government's money, everybody has to use the government's banks, and then the government prints more money, and then you're stuck. And so you're constantly witnessing your wealth devalued. So people have no ability to save, and governments have no restraints on their spending. And that's the 20th century. And that's, in my opinion, the destruction of civilization, because civilization is a process that happens because people are able to think about the future. We plan for the future, we sacrifice the present in order to get a better future. That's what makes civilization possible.
Once money lost its anchor, everything downstream started to wobble. Savings were slowly eaten away by inflation. Debt piled up because there was no longer any real constraint on spending. And governments learned something incredibly dangerous, that they could finance almost anything without having to ask their citizens for permission. That's why World War II wasn't really a clean break from World War I. It was less a sequel and more a delayed continuation of the same monetary failure. The mechanism that made the First World War possible never went away. It just got refined. And in many ways, we never actually exited the war economy after that. We just changed the battlefield. Today, the competition isn't only military. It's about energy. It's about AI and industrial capacity. It's about who controls production, supply chains, and the inputs that power modern civilization. But the funding mechanism hasn't changed. It's still financed through money creation. And it's still paid for by future generations who never consented to it. And this is where Safedean's argument goes beyond history and economics. Because once money breaks, the real damage doesn't show up immediately in prices or charts. It shows up in how people relate to the future itself. Safedean argues that if you really want to understand the rise and decline of civilizations, you have to stop looking at politics or ideology and start looking at time preference.
In fact, we could say the entire process of civilization is the process of us lowering our time preference. So we save more, we think about the future more, and then that's reflected in all manner of our behavior. We become more cooperative, more peaceful, more understanding, because we recognize that if we cooperate peacefully with each other, the benefits in the long term far outweigh any benefits that we would get from being aggressive against each other. One of my key points that I keep bringing up in all my work is that you could think of the hardness of money as being like a control knob for time preference. When money is very hard, when money is difficult to produce, then it holds on to its value in the long term. So it allows people to think about the long term. It allows people to provide for their long-term future. And that makes people more future-oriented and more likely to think of the long term. Whereas on the other hand, when money's easy to make, it gets produced at increasing quantities, it holds its value badly. And so it's a terrible way of providing for your future. So without an easy way of providing for your future, becomes more uncertain. And you start discounting the future more, you become more present-oriented. And as a result, you essentially reverse the process of civilization. So I think, and in my work I discuss this in a lot of detail, but I really think 1914 was the turning point.
The concept of time preference was a genuine turning point for me. Because once you see civilization through that lens, a lot of things that feel disconnected suddenly line up. Why saving feels harder, why everything feels more short-term, why politics, culture, and even personal decision-making seem increasingly reactive. And we talked about one major downstream effect of broken money being this increasingly gambling and casino culture we find ourselves in. We talked about that in detail in this episode here. And it's not that people suddenly became worse, it's that the incentives quietly change underneath them. And money sits right at the center of that. When money reliably holds value, it gives people room to think, to plan, to cooperate, to build things that take time. But when money leaks value year after year, it pushes behavior in the opposite direction. Not by force, but by necessity. That's the backdrop for why this conversation matters so much today. Because when people sense something is wrong with this system, they naturally start looking for alternatives. And right now, one of the most common questions I hear, especially with gold making new highs, is a reasonable one. Why not just go back to a gold standard? So before we talk about why Bitcoin is different, it's worth understanding why gold ultimately failed.
But I thought about the next best thing, which is how to make gold more like Bitcoin. And ultimately, what it comes down to is the availability of an alternative to the central banking system for clearance. And that's something that Bitcoin has, but gold does not have. Today, even, and back then, you can't just trade gold. You can't say, all right, I don't want to use my bank and my central bank. I'm going to set up a gold bank account, and I'm going to trade with my suppliers in China and Brazil with gold. I'm just going to send them ounces of gold, and they're going to send me back goods. That's not going to work. You can't do that. There are no gold banks. You can't get a license for a bank anywhere in the world if you run it on gold. And your central bank, you can't be a member of the IMF if you're on a gold standard. It's one of the conditions of joining the IMF. So if you want to join the modern global monetary system, if you as a country want to trade with the rest of the world, you more or less have to join the fiat dollar system. And there's no alternative to it. And there's no easy way of physically moving gold around. It's very expensive to move around, and it's very expensive to verify it. The only way that you can tell for sure that a gold bar is real is you have to actually melt down the whole thing and recast it, which is pretty expensive. So moving gold from one country to the other on an airplane is expensive, and then melting it and recasting it in order to verify its purity is also very expensive. So that practically means that if your central bank tells you have to deal with this currency and you can't redeem it in gold, you're stuck. You have no alternative.
This is a subtle but important distinction. Gold didn't fail because it was bad money. It failed because it couldn't exist outside of institutions. Once banks, vaults, and clearing systems became choke points, governments didn't need to outlaw gold. They just needed to control the rails around it. Bitcoin changed that dynamic completely. There's no central cleaning house, no licensing authority, no permission required to move value across borders. Settlement doesn't depend on trust in an institution, it depends on rules enforced by the network itself. That's why Saifedean's newest book, The Gold Standard, is such an interesting thought experiment. It imagines a world where gold evolves as far as it possibly can, almost Bitcoin-like. And even then, it still falls short. I've read all of Saifedean's books except this latest one, and each one of them has sharpened how I think about money, incentives, and history. If this episode has been resonating with you so far, I really encourage you to go and read his work, and to watch this full interview on what Bitcoin did. We've got a link in the description. Now, this brings us to one of the most important reframes in the entire conversation. A lot of people still believe that for Bitcoin to succeed, fiat has to completely collapse. That governments will never allow it, so Bitcoin can only win if everything breaks first. Here's Saifedean explaining why that isn't necessarily the case.
And that most people think Bitcoin rises and takes over when fiat dies, and Bitcoin has to kill fiat, and that fiat has to die if Bitcoin is going to rise. But it's entirely plausible in my mind that we just continue with the same trend that we've had over the last 50 years with fiat and over the last 15 years with with Bitcoin. And that Bitcoin continues to appreciate, fiat continues to depreciate. The fiat economy becomes smaller over time because inflation is destroying value and because people move from fiat to Bitcoin. And the Bitcoin economy gets larger over time. Extrapolate that over another 10, 20 years, 30 years. Eventually, the Bitcoin economy becomes bigger. And we have a Bitcoin economy that dominates the world. And fiat continues to become a less and less significant part of the world economy. In a sense, this is what's been going on over the last 10 years. We're repricing everything in sats, and we're redenominating the entire world in satoshis. They just need to, everything else needs to drop another 90% and in satoshi terms, and the Bitcoin economy grows another 100x or so. And then the world is effectively on a Bitcoin standard. So I've stopped waiting for fiat to die, and I'm just enjoying Bitcoin grow.
That perspective changes everything. Bitcoin doesn't need a dramatic reset. It doesn't need hyperinflation. It doesn't need institutions to fail overnight. It just needs time. As fiat systems slowly lose purchasing power, people look for ways to preserve value. Cash balances migrate, trust compounds. Bitcoin absorbs that value incrementally, one decision at a time. That's why price matters, not as something to trade, but as a signal. It reflects how much trust has already moved onto the network. And it's also why Bitcoin becomes a medium of exchange only after it's widely trusted as a store of value. You don't force that transition, you unlock it, which brings us back to where we started. When you understand what Bitcoin is actually responding to, broken money, distorted incentives, and futures that have been quietly mortgaged away, obsessing over short-term price moves starts to feel a little misplaced. Not just financially, but philosophically. And this is exactly why Swan exists. Not to trade cycles, not to chase charts, but to help people actually build around sound money and long-term thinking. Swan Private works with individuals, families, and businesses to custody Bitcoin properly, structure long-term accumulation, think through generational planning, and align their balance sheets with the principles we've been talking about in this episode. Because if Bitcoin really is a better foundation for human coordination, then how you hold it, how you plan around it, and how you pass it forward actually matters. If this episode resonates and you're thinking in decades, not quarters, Swan Private was built for that journey. So visit swan.com/no-second-best to learn more. The negative externalities of fiat money aren't abstract. They shape behavior. They shape culture. They shape what kind of future our children will inherit. And if we want a world of abundance, where technology actually benefits humanity instead of distorting and further enslaving it, the monetary system coordinating human action has to change. That's what Bitcoin represents. Not a trade, not a cycle, but a chance to rebuild on a sound foundation. But I'd love to hear your thoughts. Where do you think most people are missing the point on Bitcoin? Let us know in the comments. And if you liked this episode, hit the like button and share it with someone who's still stuck on short-term price charts and cycles. And don't forget to subscribe to the Swan Bitcoin channel if you're not already, so you don't miss the next video. Thanks for watching, and remember, there is no second best money.